Randeep Narang, Managing Director and Chief Executive Officer at Transrail Lighting. Mr. Narang, very good morning to you. Thank you. Thank you for your time with us here at NDTV Profit. Let's start talking about the order wins, 1,647 crores in all, split between railways, T&D, etc. What is the breakup? What are the detailing that you can give us on the components of this cumulative figure of about 1,600 crores?
So this is predominantly T&D, 95%, and we have a railway electrification order in India. The rest of it is from international markets. And if you recall, we have also announced 2,700 crores last month. So in this quarter, we've taken orders worth 4,400 crores.
Okay. So what is the timeline that you're going to be seeing in terms of execution of these orders and when they start hitting your books?
So keeping in mind the general engineering approvals and the process of startup, it will take us 24 months, 2 years to complete these jobs. And that's the process. Domestic jobs will be a little faster, going up to maybe 20 months and international 24 months.
How much of this pie is international and how much of your entire order book is international?
So today, out of this 4,400, 60% is domestic, 40% is international. But if you see a complete order book, we'll be around 55, 45 or closer to 60 domestic and the balance being... So the mix is changing a bit because we got some very good orders in India recently in the last 2 to 3 months.
Mr. Narang, good morning, Neeraj here. So, would the book-to-bill ratio be at around one times? Would that be a fair assessment? 9 months, you've done what, about 3,400 crores of revenue. So, is the book-to-bill around 1x?
It should be a little more than that because the way the order book is coming in, it's going to help us improve this.
So, which is what I was going to try and understand, because a lot of your peer sets might have a slightly higher book-to-bill ratio. Now, are you in the process of building it up, or are you being very picky with the kind of orders that you're winning because they might have better margins or more predictability? Fill us in on that.
I think it's a very good question. As an EPC player, we're very careful. We have a risk matrix. We figure out what is the right job for us, what is the margin profile we need, the geography, the funding agency. So we are picky, and we believe that the quality of the order book is very important as we go forward. So we're not in a race to pick any order. We are in a race to look at a quality job, quality order with the clear mandate to complete the job within 2 years.
But I stand corrected, right? Because your total order book, I mean, the order inflow would have been 4,400 crores, sir. The total order book is northwards of 15,000 crores, if I'm not wrong.
Yes, so 9,200 fresh order intake we have taken. And overall, it will be around 15,000 with the execution happening in this quarter.
Yeah.
We also have some L1s around 1,200 to 1,400 crores.
Okay.
So we are in a steady state so far.
Got it. Yeah. So I stand corrected. Of course, the book-to-bill is much better than the 1 times that I was thinking of. Okay. Fair call. Now tell us, when I look at Q3, for example, Mr. Narang, and we didn't get a chance to talk post Q3, phenomenal jump. One, how has Q4 been? Has it been as strong as Q3? Because that would take your annual performance much higher, because the 9-month performance relative to Q3 looked a bit muted, right? Because your Q3 was phenomenal. How has Q4 been? We are almost at the end of Q4.
Yeah, so as you know, our industry, the first H1 is normally slow, and H2 is really where the execution happens post the monsoons. So that's been good for us too. And we believe, as per my earlier guidance, we did 4,000 plus crores last year. So we will look at a 28-30% growth this year, and we are on track for that.
Okay. Sorry. So just one follow-up before I hand it back to Tamanna. So if you do about 28-30, which would mean your Q4 numbers could also be about between 25 and 30% growth, or maybe around that period.
We're looking at that range, kind of, because that's the trajectory we have to maintain to achieve what we have set up for.
Okay.
Mr. Narang, I just wanted to come back on the point of the international focus, because you talked about how domestic orders have been bumping up. But previously, you've also said that international is something that you want to focus on. I want to understand regions and whether that outlook has changed, whether you're going to, in light of everything that's happening around the world, whether you're going to focus more on domestic orders and whether you see that order flow then keeping up consistently domestically.
Ma'am, that's a good question. So principally, we still maintain that our focus internationally will continue. Again, as I said, we pick and choose our orders based on the margin profile and the geography. So the international focus will remain, but we see a very healthy trend in domestic infrastructure opportunities. And again, these are focused margin-led jobs with good quality clients. So we are balancing both, and we are very happy that if we can execute well and we have a good margin profile, we will prefer whether domestic or international. But the international focus is not going to change. It continues as it was.
Yes, but what geographies then are you focusing on? And then
We
my
are
core question about, whether you're seeing any impact from what's happening around the world.
not really, because we basically work in Africa in a big way, Southeast Asia. We are not in Middle East right now, so we are picky choosy there. Fairly, and India, of course, we are there in a big way. So both Africa, Southeast Asia, India markets are growing, and we are predominantly focused on T&D, which is 92% of our revenue. So we believe that this is where we are good at. We are good in engineering. We are good into execution. We have a good business development team. So T&D is our focus, and that's where we are.
Just in terms of your capex outlook, I mean, you're relatively recently listed, well-funded. I think the IPO also came at the right time for you in terms of how the markets have panned out after that. What are the kind of capex plans you're looking at for the next financial year as well, if I were to ask you to look at FY26 now?
We announced 327 odd crores of capex approval from the board last month. And this we want to bring into fore in the next 24 months. Work is already happening. We are looking at brownfield project expansions of our tower and conductor factories, 3 of them. And we are looking at a new capex for a new factory for towers, which is again, we are planning to do so in the next 12 months. So looking at our order book, these are bare essentials we need to make sure that the customer satisfaction happens. And we are focusing on the same to complete the jobs on time.
No, agreed. Just coming to, the core business and the metrics, wondering whether you're seeing margins sustaining at this, 12.5%, 13% clip into Q4 for this financial year and for FY26 as well. Was this an initial boost we saw, or is this the levels that you see going forward?
And when we actually went for the IPO, we had given a guidance of around 12%, 11.99, 12. We still maintain 12, 12.5 is something we can sustain and deliver. And whatever orders we pick and choose, we look at that kind of profile to maintain the future also.
Okay, Mr. Narang, there are some comments in the con call about the backward integration as well, right? Now, what's the strategy here? Is it to secure or have control over the supply chain as much as possible, or is this margin accretive a move, or both?
Both, actually, because we are into tower manufacturing. We are also into conductor manufacturing. We have a complete range, including AL59, ACCR, we have STLS. So this helps us to bid for EPC jobs and be more competitive. We are also looking at our own tower factory expansion. And the construction pitch, which is 30%, is where we do the delivery. So principally what we are seeing is that the backward integration which happened in our company almost 15, 20 years ago is helping us to look at securing future orders and being more competitive in the global market and local market.
Okay. Mr. Narang, when you came out of the IPO, and since it's, or rather when you last did a call, there would have been some vision requested from you by some of your large investors about what you think the company would move towards over the course of the next 3 years or the 5 years. What's your response been there? Because this is a pocket which is very active. There are government spends there. They might be chalky over a particular year, but broadly the trend is upbeat there.
Yes. So we did a 3-year strategic plan when we went before the IPO, and we truly believe that We're looking at this year 28-30%. We're looking at going forward. I would like to say the same trajectory will happen, maybe 25-28%. And we are seeing this growth because the order intake is good. So we see a good 2-year horizon for sustaining our revenues.
About between 25 and 30% would be a safe
I would,
CAGR assessment?
I would tone it down to on the lower side. 25% is better to say
Okay,
rather than
no,
saying.
I'm only saying this because you mentioned 30% and 28%. So hence
That
I
was
said
this year. 28-30 is this year, but future I would tone it down a bit to
25%.
around 23-25%.
23 to 25% while maintaining margins at the very least to about 12 to 13%.
That is the key driver for us, maintaining margins and delivering
And
value
and
for holders and shareholders.
and last question, you won't need any kind of further capital raise in the immediate future, equity linked?
No, we don't think. We have already thought of this as a 3-year plan, which will sustain for us. So we are good to go.
Okay. Mr. Narang, we'll leave it at that. Thank you so much for taking the time out and being with us. Appreciate your time.